Welcome to BSc Prudent Investor. You're watching ET now. Thank you for joining us. Now, over the last few weeks, we first talked about opening a demat account, buying your first few stocks, and we even discussed possibly trading online. Today, we're going to talk about futures and options. And if it's an option that you should be using when you trade in stocks. Now, to help us answer all of the questions that you have with FNO, I have a wonderful panel of guests joining me in the studio this week. I'm going to do a quick round of introductions. On my left, Dipesh Mehta, derivatives analyst at Nirmal Bang. Thank you for joining us. Hemant Tukral, national head and derivative desk at Aditya Birla Money. Amit Trivedi is a co-founder at Investworks. And of course, Bhavan Desai, senior manager, equity derivatives analyst. Thank you so much, all of you, for coming in. Let's start with you, Dipesh. First of all, I'm going to ask you a really basic question. For viewers who are watching, who understand how to buy and sell a stock, tell us how derivatives are different.
Buying and selling remains the same. We have an electronic platform where the futures market is traded, where a large number of buyers and sellers come to a common platform, and the best bids and asks are actually traded as the price are matched. So that, for example, if you talk about a buyer who wants to buy a X stock at 100 rupees, and if he gets the similar seller to sell the similar stock for 100 rupees, so the electronically it is matched and the whole trade is executed for the same.
All right, Hemant, do you want to give us an example? Assume instead of a stock, we are buying a pen, and I want to be able to make a futures deal on this pen at the price it's currently trading at 10 rupees. Can you tell me how it works and how is it different from just buying it straight off the market?
See, I would put it in more layman's language. First, we have to all understand what is a futures contract all about. It's a financial contract between a buyer and a seller, wherein you are quoting a future price on a future date and you are buying and selling today. So we have an expiry date, and today we are buying and selling, quoting the prices and quoting a premium of prices on those days. See, for me, if you ask, I think the basic difference, if one has to understand between cash market and futures market, he has to understand just three words. One is lot size, one is margins, and one is mark to market. So if I give an example of pen only, now if I have to buy one pen, I have to go ahead and ask him, give me one pen. Now in this, the lot size are fixed. So that means I have to buy 10 pens if I have to buy one future. So that means that 10 pence is fixed by the exchange. That cannot be changed. Second is margins. That means for one pen, I have to pay 15 rupees. So I will pay 15. Here for 10 pence, I don't have to pay 150. The margins are predefined by exchange, maybe 15%, 20%. So you are paying less. That means it's a leverage thing. And third is mark to market. That means if the pen price increases today to 16 rupees, I gain 1 rupee. If the pen prices comes down to 14, I lose 1 rupee. So daily this mark to market will be settled till that contract date does not reaches. So I think if one can understand these three simple steps, that is lot size, margins and mark to markets, he can easily understand the difference between the cash and the futures market.
All right. I mean, could you take us through the difference now between futures and options, because they're both derivative trades?
Yeah. See, futures is like the payoff of a futures is similar to buying a stock. So suppose if you buy a Reliance share whose price is 1000 rupees today. If the price of Reliance goes up by 1 rupee, you will make 1 rupee profit. If the price of Reliance fall by 1 rupee, you will make 1 rupee loss. If you buy a futures of Reliance, right, the price will be something, the payoff will be something similar. So if the price of Reliance futures goes up by 1 rupee, you will make 1 rupee profit. If the price of Reliance futures goes down by 1 rupee, you will make 1 rupee loss. In options, the payoff is not linear. What that means is, if you buy a call option, for example, of Reliance 1000 strike, and if Reliance price in the cash market goes up by 1 rupee, then the price of option will go up not by 1 rupee, but around 50 to 55 paisa. Similarly, if the price of Reliance falls by 1 rupee, the loss also, or the price drop, will not be 1 rupee, but around 45 to 50 paisa, which is called the delta of an option. So the fundamental difference between a futures and an options contract is, in futures contract, both buyer and seller are required to settle the contract, Whereas in an options contract, the buyer has the option if he wants to exercise the option or not. The seller has the obligation to exercise that particular contract.
Okay, so it's actually an option at the end of
Option,
expiry whether or
yeah,
not I
yeah.
want to. See, it all boils down to just predicting what the stock price will be. Now, for somebody sitting at home right now, how do you arrive at that prediction?
Well, a lot of people like you, smart people like you, have taken this initiative in bringing along a lot of intelligent people and telling them where the market is expected to go. However, what we recommend is that it is better to do your own research first. Okay, subscribe to something, understand what the dynamics are, understand what you are dealing with. Okay, and then go ahead and trade into that particular market. And then once you are through with it, once you understand equities, once you know that this is how the businesses are valued, and this is how the value of these businesses fluctuate, and thereby changing the value in the share price. Once you understand that, then get into the derivative of these shares and get into the futures and options. Futures and options are a beautiful instruments if you understand them very clearly. The idea is very simple. It is like a highly boosted high performance vehicle. Now it is just that you have to be a little more efficient in driving it and taking certain amount of precautions. Otherwise, the mishaps could get you into a bigger trouble than what a normal share trading can. And similarly, it is a race car. It can get you from one point to the second point faster than your neighbor.
All right. Do we have any questions from our audience? Yes.
Good evening. My question to you is, as a first-time investor with limited capital, what are the kind of derivatives that would be safer for me to invest in?
This is a trick question. Safer derivatives?
I would put it this way, that what just Bhavan said, that a safe race car is very difficult to find out. But yes, if you have a limited money, I would still put it in through an index future rather than going in a stock future. There are two particular reasons I'll try to explain you. Index volatility is less, stocks volatility can be higher, and index obviously is consisting of 50 stocks, for example Nifty. So to make Nifty volatile and to experiment, if you want to experiment with futures with limited money, it's always more useful to enter an instrument which is less volatile and takes less margins involved or give less M2M losses, so that it gives you a feeling that how the market is functioning. So I would actually go and put in money in index future rather than looking for any stock future if I have limited capital with me.
All right, we're going to take a very quick break, but when we come back, we will talk about what sort of reading we should do before we start any sort of futures and options trading. Don't go anywhere. Welcome back. You're watching BSC Prudent Investor on ET Now. Thank you for staying with us. We're talking about futures and options trading. Amit, I want to bring you in here. Now, in the previous episodes, when we talked about just buying stocks for the long term, all of our guests advised us to look at the fundamentals of the business, look at the management, look at the track record of the stock and the company, and then buy. Now, when I'm doing a futures and options trade, don't I also have to then consider the technicals of that stock? Tell us how to do that.
Yeah, so if you look at compared to buying a stock, the technical analysis that you do is slightly different from what you do it while you are doing in futures and options, right? The fundamental difference is, if you have bought a stock, you can hold it for 1 month, 2 months, 3 months kind of thing, right? But futures have a life, or all derivatives have a life. And in India, the derivatives trades that mostly take place happen in the near month contracts. So if you look at like now, it will be May month series which will be the most active, right? So here some of the parameters that you would like to look at is the first fundamental thing is what is the open interest that you have, right? Open interest is basically the number of people who are either buying or who have sold that particular futures contract and are still in the game, right? So that's an interesting, that's an important point, because that gives you an indication of how volatile this particular security will be. The other thing that people look at is, especially in the options data space, because options there is something called strike price of an option, right? So what is the open interest at different strike prices? That kind of gives you some indication of what the market mood is looking like. Because the fundamental thought process in the marketplace is that an option seller, because he's exposed to a bigger risk, is more aware of market than the option buyer. So if there is like for example, Nifty is at 6,800 and there is a lot of open interest on the call side at 7,000, that can give some kind of an indication that market participants don't feel that the Nifty will go beyond 7,000.
Hemant, take us through this. You did say, of course, there's no such thing as a safe race car. For anybody sitting at home who's going to experiment on advice that they've heard right now, what sort of risks should they be prepared to take with the money that they're using? Should it be money that they're prepared to lose altogether? Should I just start off with a small amount of play money, prepared maybe to make a mistake or two?
See, I would say, just to add what Bhavan said, that if you can start with a smaller money place, like buying a call option. See, now you have understood the study material. We have to understand just one point. I'll put what both Amit and Bhavan said. It's more of a sentiment study. Indian market works more on sentiments rather than anything else. So if sentiments are proven through actions, so if all of us have taken an action to sell 66 put, right, and put writing or sorry option writing is slightly more riskier, I would advise you buy a call. As Bhavan said, you have a limited money, you have put only say 3,000, 4,000 rupees. Now this is an experiment that you are doing. So if this works, it does take supports and rebound back, that 4,000 can make 6,000, and maximum loss is predefined. You have bought an option, so your maximum loss is 4,000 rupees. So that is where you can start with. Now once you get the grip of things, then I would like you to adventure with futures. But first, if you are I would say initiating something in future and options, it's much better to start with an option buying, not even writing, option buying, which has a predefined risk.
All right, Dipesh, tell us this now. We earlier talked about the fact that there are options of us, not the same kind of options, of us taking courses to actually learn how to trade on the markets. There are courses being offered by both exchanges and by several other entities. Before we start futures and options trading, is there any reading material that you would recommend? Are there courses that you would like investors to take?
See, the NSE is also taking a lot of initiative to come up with a lot of courses. But apart from that, if someone just wants to read good books, a couple of them are my favorite in technical analysis. One is the Maggie, one is the Martin Frangi. Both these books are good on technical analysis. They are the basic books on technical analysis.
We're going to take a quick break. When we come back, we'll talk more about futures and options, and we'll take more questions from our audience. Don't go anywhere. Welcome back. You're watching BSE Prudent Investor on ET now. Thank you so much for staying with us. We're talking about futures and options. Hey, but there's also a theory that I can use my futures trade to hedge against the trade that I've done in the secondary market. Explain to our viewers how that's done and how they can use it.
See, I'll put it this way. Now there are two ways you can hedge it. First, as I just described, you have something called an index future. So if there is an event called as election, actually this question is perfect because an event is there. You have such a big event like election, and I have a portfolio of 2-3 crores. So I can see that how much stocks I have. There's something called as a term as beta. That means that if that particular Nifty goes up by 10 points, the index, how much that stock is affected. So that is the beta of that stock. So if I can compute the portfolio beta, then I can hedge it by selling the same amount of Nifty futures. So whatever happens during that volatility of the event, I will escape. I can hedge it, and even if there is a big fall, my portfolio may not get affected, and it may happen that I may end up making some money or at least hedging my portfolio to some extent. The second hedge, I would say, what beautifully the exchange has done is now VIX futures. Now we have something called as India volatility futures, which have been introduced lately, though it is still not for retail investors because the margin requirements are high, But still, if you are having a portfolio of say 10 lakhs to 20 lakhs, you can only buy one index VIX futures and hedge the entire portfolio.
Amit, let's also talk about the time this needs. Now, for someone who has a full-time job, if I'm in the office from 9 to 6 every day, futures and options require a certain amount of attention. As you gentlemen know, you have to stay with your computer. What sort of research and time should I be willing to give these trades if I'm going to be an active retail trader?
See, basically it depends on what is the strategy that you are following. So there are people who trade tick by tick, or in a few minutes they want to get in and get out. For them, of course, you cannot be at the job and then look at this also. But at the same time, you can create a payoff strategy. So for example, as we were discussing, assume this is not an election month. I would not advise anyone to trade using any derivatives for this particular month. But assume we are in the month of June, everything is set. And then you have a view that, okay, my sense is that market will not go below 6,000 or Tata Motors will not go below 390 rupees. Then what you can do is you can sell some put options of Nifty or Tata Motors at that point of time. Those trades you can live till the life of that particular series, which is 20 days, 25 working days kind of thing. If you think that you would like to trade for a slightly 3 to 5 days kind of thing, then you need to be more attentive to where the market is moving. Because if this market moves and if you have not been vigilant, your losses also can be quite deep.
Pavan, if the losses are going to be that much deeper, how important is it for me to maintain stop losses to make sure that, okay, this is where I cut the pain and make sure it doesn't go any further?
Right. Okay. I'll cut the question in two. Let's just say that you're on the buy side and you're on the sell side. Okay. On the buy side, most of the people live with the fact that if 100 rupees worth of premium, that is something that I've paid, then that is the maximum that I'm willing to lose. You have a view in mind that the stock will go up or it will go down. You buy a call option or a put option respectively, whatever the view is. Okay. Your view doesn't materialize. Let's just say 4 days, 5 days go by, 4 trading sessions, 5 trading sessions go by. Then it is better to let go of it. These fruits are getting rotten. Okay. It is a wasting asset basically. So that has to be kept in mind every time you take that trade. That is one. Second thing is, chances are that on a future date, chances are that the price objective that you had in mind right at the time of taking the trade would actually come in, still you wouldn't make any money. Why? Because of that erosion of value. So that is the first thing on the buy side option. That is the stop loss mechanism that has to be followed on the buy side of the option. Second is, if you're on the sell side of the option, remember one thing, that economically speaking, I'm not taking any jargon, I'm not taking any philosophies and nothing. Just economically speaking, for any rational guy to take a trade, if I have maximum 10 rupees to make, I am not going to risk more than a penny more than 10 rupees on that trade. So the moment an option sold at 10 rupees